Hello and welcome to TalentSprint again for yet another video presentation related to the banking subjects, and this time we are going to talk of demand loans. We have already seen what are the various types of loans that can be granted by a bank to a customer or to a borrower. One is an overdraft, one is a cash credit, the third is the demand loan, the fourth is a term loan, and the fifth is a gold loan, and the sixth is a mortgage loan. So out of these six, now we are taking up demand loans for discussion. What is a demand loan? A demand loan is a form of loan that can be called for complete repayment without any prior warning to the borrower. That means a demand loan, just like a demand deposit, is repayable on demand. If the bank is not satisfied that the customer is not adhering to the rules and regulations of the grant of the loan, then the bank can very well call for the entire repayment of the loan, and that is called a demand loan. When we say without notice, we understand that very often a 24-hour notice is all that is given for the repayment of a demand loan. The demand loans are given against security of an asset, namely gold ornaments or jewelry, for example, is a demand loan, and these can be recalled by the bank at any time. For example, if the gold ornaments are found to be fake, then obviously the bank will recall the entire amount by just giving a 24-hour notice. They are given for a period not exceeding 1 year at a time. They are not given for long periods, they are given for a period not exceeding 1 year at a time, and they can be renewed subsequently. Demand loans are always secured in nature. If you recall the earlier video where I said overdrafts are normally given without any security except for the guarantee of a third person, demand loans are always given against the security of something. Demand loans are given against the security of gold ornaments, against the hypothecation of goods, and against the hypothecation of car, two-wheeler, etc., etc. They are all called demand loans. Demand loans are always secured loans in nature. Amongst the documents for a demand loan is a demand promissory note. What is a demand promissory note, or what is popularly known in banking circles as a DPN? What is DPN? Demand promissory note means it is a statement of acknowledgement by the borrower saying that on demand I agree to repay to the bank the sum of rupees X along with interest thereof from such and such a date till such and such a date. That is the classic example of a demand promissory note, or a DPN. A DPN has to be obtained from the customer when the loan is sanctioned. When the loan is sanctioned, the customer signs a demand promissory note saying that on demand by the bank, I so and so hereby agree to repay to the bank the amount of such and such rupees along with interest at the rate of so much percentage on and from this date to this date. That is how a demand promissory note is always worded. This demand promissory note legally is valid for a period of 3 years. Once a demand promissory note crosses the 3-year period, then it becomes what is known as time barred. A time barred demand note cannot be executed by the bank. So it is very important for the bank to keep the DPNs always alive, and that is why we will find that banks always chasing customers to ensure the DPNs are alive by taking renewal documents from them every year. The loan may not have been repaid in full, but at least the documents are in order so that they can proceed against the borrower if required. So the main component of a demand loan, the main document of a demand loan, is a demand promissory note. As I told you, in the demand promissory note, the borrower agrees to pay or agrees to repay on demand. So this is how the concept of a demand loan works. The demand loan is a type of loan which is repayable on demand, for which no notice is given by the bank except for a 24-hour notice, and it is repayable by the customer without any preconditions being set. And demand loans are always secured in nature against gold ornaments, jewelry, hypothecation of raw materials, and hypothecation of car and hypothecation of two-wheelers, etc. These are all the classic examples of a demand loan, and one of the most important component of a demand loan is that it's a DPN, is the demand promissory note, wherein the borrower says, I agree to repay on demand. So this is the concept of demand loans. This is how the demand loan works. So this is how the demand loan works with the banks. And until I see you in the next video, is bye from me for now, and thanks for watching.